Good day, investors. This video wraps up my coal review series where I analyze 7 companies in the global coal space. Based on the key performance indicators of valuation, profitability, debt, coal mix, and qualitative factors, I've narrowed down the list to 3. First, I would like to highlight why we look at coal. We look at coal because it's hated. Institutional funds will not touch it despite fundamentals. So the investment case here is that you can find companies which have really strong fundamentals but are underowned, therefore they are cheaper. And if you look at fundamentals, world total energy consumption, 28% is coming from coal as of 2024. And actually, hydrocarbons are a really large chunk, 87% of all energy consumption. In general, you have increased energy consumption when GDP rises. Plus, now you have the AI demand, which will boost this. So as of recent commentary from Steve Eisman, I heard in the US alone, energy demand was growing around 1% per year, and now it's 3% per year due to AI. Alright, so looking at coal mix, coal falls into 2 categories: metallurgical coal, used for steelmaking, and thermal coal, used for power generation. I'm personally focused more on thermal coal, driven by rising energy demand tied to GDP growth, increasing electricity intensity, and additional load coming from AI data centers that require reliable baseload power. Energy security is also a key global theme. To put some numbers around this, recent commentary from Steve Eisman, as I just said, increase of energy demand in the US from 1% to 3% is meaningful acceleration driven by AI, not to mention that without AI driven demand, globally coal was still underinvested. So in contrast, met coal is tied to steel demand, which declined about 1% actually from 24 to 23, according to the World Steel Association. Although long-term demand is still slowly increasing, so there is no drop-off of steel demand. What this chart shows clearly is that most producers are specialized. They tend to be either thermal or metallurgical coal producer and not the 50-50 balance. And for Glencore, I've adjusted the data to reflect only its coal exposure split by coal time. So if you think about Glencore, it's 50% coal and 50% other stuff. So I only used the coal part of the business when I looked at the division where it sits. And then you can see these companies, for example, Warrior Met Coal is fully met, and then you have Tangila, which is fully thermal, and then between you have these mix of, but they are generally very focused on one type. Okay, starting with valuation. The goal here is to look at companies across the cycle, not just at peak or trough earnings. On the vertical axis, you see 7-year average TAM cap takes, which takes the average free cash flow over the past 7 years and applies a 10 times multiplier, which is equivalent to a 10% free cash flow yield. So what would be the market cap if I get a 10% yield? On the horizontal axis, discounted free cash flow value is modeled future cash flows discounted with 10%. What stands out clearly is that Tangila and Yancoal screens as the cheapest on both metrics. So both historically they are cheap, and then future valuation is cheap based on future projected cash flows, offering strong upside in both cases. Whitehaven and Peabody still show reasonable upside, though less compelling relative to the other two. And if you look at AMR, so Alpha Metallurgical, the historical cash flows suggest that across the cycle, value may be higher than the discounted free cash flow suggests. This could be because this actually happened in the past, and this I put together in the models. You can watch the videos, and I tend to be really conservative with my future expectations. Okay, valuation part 2. This is a second way of looking at it, using simpler multipliers. On the vertical axis, we have 7-year average price to free cash flow, which you can think of like a price to earnings ratio. So today's market cap divided by the average free cash flow over the past 7 years. So it's like a 7-year average PE. On the horizontal axis, we are looking at a straightforward price to book multiple. The takeaway is very consistent with the prior slide. Tangila and Yancoal are by far the cheapest in both measures. Peabody and Whitehaven sit in the middle, still reasonable but clearly less compelling. And then you have Alpha again, screens more expensive, particularly in a price to book ratio relative to the other two, BTU and VAC, so Peabody and Whitehaven. But again, we see that these two is the cheapest and then followed by these other three. So both valuations screen the same. All right, let's look at now. Turn to profitability. This chart looks at 7-year average return on equity and return on invested capital. What may surprise some investors is that the cheapest companies are not the weakest operators. In fact, if you think about Tangela was the cheapest by both metrics, by both valuation approaches, but still stands out as the most profitable name on both return on equity and return on investment. Maybe return on equity, Warrior Metallurgical is a bit higher. Warrior Met screens also really nicely on profitability, and then you have Yancoal and Whitehaven and Alpha, which are solidly profitable as well, clustering in a similar range. Peabody, on the other hand, drops off meaningfully on profitability, and Glencore has delivered relatively weak returns historically, which is notable given that it also doesn't screen as a cheap company. So overall profitability reinforces that valuation strength here is not coming at the expense of operating quality. So if you recall, Glencore was not cheap and it's not really good on profitability metrics. And Tangela and Yancoal were really cheap and they are also really profitable. So these have other reasons why these are. So it's not just the fundamental profitability that drives valuation. That's my point. Looking at debt, so look at the balance sheet strength and solvency. The red lines reflect my personal criteria. Debt to equity is this line, which would be, my criteria is debt to equity to be 50% and interest coverage ratio to be above 5 times. So starting with Glencore, it clearly fails both tests. Leverage is above 100% debt to equity and coverage ratio falls below my minimum 5. It's actually around 3.2. Coverage, and then 107 or something debt to equity. So they are in pretty bad shape. In contrast, most of the remaining, actually all of the remaining companies meet the requirements comfortably. In fact, Tangela and Alpha and Yancoal stand out with effectively they have no debt. And have very high coverage ratios, which gives them significant resilience across the cycle. This is basically the only moat you can get in a price taker business. Of course, you can be a low-cost producer. That's the real moat. And then the second one is you want to have a fortress balance sheet because of the cycle. Whitehaven is still acceptable. Begins to fall out of the top tier, right? Still, like, its balance sheet is within requirements, but it's not as top tier as this. So valuation and profitability are solid, but the balance sheet is meaningfully weaker than the strongest peers. Now, based on everything we have covered, these are my top 3 picks. First, you have Tangela. It is the cheapest name in the group, and at the same time, basically the most profitable and have no debt, and they are 100% thermal coal. That positions it directly to benefit from energy demand growth, including the additional tailwind coming from AI data centers and the broader energy security theme. The main risk here is geographic. The business operates primarily in South Africa with some Australian exposure, which actually does introduce jurisdictional risks despite very strong fundamentals. When I tell somebody about this company, the first question is that, oh my God, South Africa, do I want to go there? So that's your risk here. Second is Yancoal. It's also very cheap, it's very profitable and carries no debt. The key risk to be aware of is ownership. Around 70% of the company is controlled by Chinese state-owned enterprises. The main controller is 62% and it's a Chinese SOE, and you have the other big shareholder is 8% and that's also a Chinese SOE. So the company is basically controlled by Chinese SOEs, which introduces political and governance risks to the business. So basically, this is a Chinese SOE company. Third one is Alpha Metallurgical. This one may be less obvious at first glance why. However, because it's not as cheap, for example. However, it remains very profitable, debt-free, and could look cheap if coal prices move higher. Despite my preference for thermal coal, I include AMR because of management quality. Insiders own roughly 16% of the company. Capital allocation has been exceptional, and the track record on debt reduction and share buyback is outstanding. I'm not sure if I've ever seen management of this high quality. That said, going forward, I will likely finish covering the major iron ore producers and then return to oil and gas, where I believe the sector is deeply unloved, but offers a much better fundamental risk reward than most people would expect from oil and gas, especially in today's rhetoric with oil glut you can hear it, you can go to Twitter, everybody talks about an oil glut. All right, so if you enjoyed this analysis, please like and subscribe, and let me know in the comments which companies you would like me to cover next, and I'll see you next time. Take care. Cheers.